spoke to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None! And Bill Poole has no idea what it's like out there. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts. They're nuts. They know nothing. I have not seen it like this since I went 5 bid for 500,000 shares of Citigroup when I got hit in 1990. This is a different kind of market, and the Fed is asleep.
Okay, but here's the thing.
Bill Poole is a shame. He's shameful.
Hold on.
Coming up on today's show, stocks bounce back from yesterday's sell-off, how to know when stocks have peaked, Zuck takes a swipe at Apple, and I explain to you how pairs trading is done. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. I hope you're all doing well out there, and I hope you enjoyed that little intro of Jim Cramer's meltdown live on TV back in August 2007. And he was actually making the point that the Fed members didn't fully understand the subprime mortgage crisis, and they needed to open the window to banks, lower rates, and get ahead of it. To which it was said they actually laughed at him, but it turns out he was right. Just a little over a year later, I'm sure a lot of you remember, subprime blew up and almost took down the whole global financial system with it. Unless the US federal government didn't step in with their huge $750 billion TARP program at the time, which really saved the day. But anyway, moving into today's market, we got that bounce back after yesterday's sell-off. Once again, the market just buying the dip, which started in the last half an hour of yesterday's trading. And so it was led up by software stocks today. Had a good bounce in the semis and a bit mixed and flat in the defensives, healthcare, utilities, and consumers defensives. A little bit weak, led down by Kraft Heinz today after they reported earnings. And there we are in the S&P 500 closing smack bang on 5,000 today. High highs, high lows. This market's not going to give up too easy. Like I said, until we close underneath the 50-day VWAP, currently at 48.53, the market won't be confirmed to be in a short-term downtrend until then. There's a look at the composite chart of the Super 6 mega cap tech stocks. And even though we saw the Russell fall over 4% yesterday, it bounced back 2.3% today. So we're getting a bit of volatility here in the market. There's a look at some of the hottest stocks, ARM Holdings, finishing up, but on a bit of a dark cloud cover. Candle formation, and wouldn't you know it, look at Super Microcomputer. What an absolute tear this thing is on. Up another 11% today, and just on these super heavy volumes. So only a month ago, it was averaging about 3 million shares traded a day. And here we are today, trading just under 20 million shares. And that doesn't even tell the full picture, because back when we were trading 3 million shares, it's around $300. Stock price, not only has the volume absolutely exploded, it's still putting in these huge numbers even though we're trading at $880 a share now. And so even though it only has a market cap around 50 billion, which is a fraction of these other mega cap tech stocks, it came in number 2 today as the second most liquid stock, trading $17.2 billion worth of shares. So that's approaching 50% of its market cap. In other words, currently traders and investors are turning over 40% or so of the market valuation of the entire company every day. Just goes to show you the level of activity and participation in this stock. Same deal with ARM, 5.2 billion worth of stock traded today. They got a market cap of about 120 billion. Seeing the same thing in the options market. Super Microcomputer coming in number 4 today, $916 million worth of calls traded, almost quadruple the amount of puts. And once again, NVDA just absolutely dominating option volumes, 2.73 billion traded. That's multiples of the S&P 500, 754 million. And we're seeing the others show up in here as well. ARM, and even Marathon Digital Holdings showing up in the top 25 list today, even though they've only got a market cap of 6.5 billion. That's thanks once again to another rip in Bitcoin, currently holding ground above 51,000 here. And that's causing some big moves in other crypto-related stocks like MicroStrategy, which you could pretty much think of like a Bitcoin ETF, because I think they hold almost 200,000 Bitcoins, because they don't have much of a real underlying business, just some legacy enterprise software that a few customers are kind of locked into. And just looking at the revenue, over the last 5 years, it's actually flat from their underlying business. This is pretty much just a play on Bitcoin, this stock. And it too has got some heavy, huge volumes coming in. Other smaller ones as well, like Riot Platforms. Ripping up there now. And there's a look at the big fella, NVIDIA. We'll get earnings from them this time next week. That should be interesting. And the tear continues. Just sitting below all-time highs here today. And so we got volatility pick up yesterday. There's the VIX index, which had a huge spike up to almost 18 just a couple of days ago. We were trading at a 12 handle. And so the juices are flowing in the market at the moment. Animal spirits are well and alive. Got a lot of participation, especially in these smaller names. Things have been parabolic for a while now in the tech semi-space. And so when things are loosening up like this in the market, getting a bit dicey, volatility spiking up, that's a great environment to do some spread trading, also known as pairs trading. And just to give you the most used example in this space, basically you find two assets that are fundamentally correlated. For example, like Coca-Cola versus Pepsi. They're both in the same business, affected by the same macroeconomic factors, so their two stock prices can have a relationship. And if you're a user of TradingView, you can create a spread chart or pairs chart by just typing on your keyboard the first stock ticker, so KO / Pepsi PEP, and then I multiply it by 100, just so the ratio is a number we can work with. Otherwise, it's like 0.03 or something like that. And so the basic idea is you have pairs of assets that are fundamentally correlated, but you also have to prove that they're technically co-integrated. And basically, co-integration is a superior measure of correlation, as it proves there's a stable, mean-reverting relationship between two assets. And so the idea is when the pair goes out of whack, when there's a technical divergence like here, the idea here is you go long Coke, short Pepsi, in equal amounts. So $10,000 long Coke, $10,000 short Pepsi. You want to exit when it comes back to some sort of technical fair value or the mean. So here in my yellow line, that's the 50-day VWAP. However, stocks have a bit of tail risk in them. They can gap up and down on unexpected news. That's why I prefer to do pairs trading on ETFs. And I'll just take you through a list now of a few pairs I've been scaling into yesterday and today. As like I said, when we get a spike in the VIX, we can get a bit of dislocation in the market, and you want to keep a bit of dry powder for when this VIX really spikes. You can find some great pairs trades out there. And the great thing about it is it keeps your portfolio market neutral, equal amount of longs and shorts. And so you're not betting on the direction of the overall market, but rather you're betting on the relationship of two co-integrated assets. And so looking at this first pair, this is two momentum factor ETFs. And you can do technical analysis on a spread chart as well. I use my indicators here to help me identify when it may be a good time to enter a pair and looking at the distance from the VWAP and other things like that. Here's another one that's currently diverging. Two material sector ETFs. Here's another one, JXI versus IDU. Two utility sector ETFs having a big divergence, two multi-factor ETFs, and finally the Vanguard small cap ETF versus the iShares small cap ETF. So the idea up here is to short the first ticker, long the second one, equal dollar amounts, and then exit when it comes back to the mean, which it always eventually will. And if you do it right, your win rate will be about 70% when it does come back to the mean. And so this is really good diversification for your overall portfolio. These trades will be uncorrelated from your typical long-only portfolios. But like I said, you've got to make sure that you're dealing with not only fundamentally correlated pairs, but technically co-integrated. And there's a few other things you've got to look out for as well when pairs trading. And that's something I dive deep into with my new online course that I've currently got on sale for just a few more days only. And so if you want now, you can get access today. And you want to watch module 14 called Spread Trading, where I've got an almost 30-minute video telling you exactly how to do this strategy of pairs trading. I'll also share with you my ETF pairs watch list, over 200 ETF pairs I've tested for co-integration. And I'll also teach you how you can test for co-integration as well. And don't worry, you don't need any programming or coding skills. My whole course teaches you how to do everything just using basic, easy skills. And I'll also show you how you can automate trades into your brokerage account, use AI and other things like that. And once again, you don't need any coding skills to be able to do all this. And if you're not into pairs trading, that's okay. I've got plenty of other modules sharing with you all my active trading and investing strategies, like the one I use on trend following stocks. I also run you through back tests of my system, showing you exactly how it works. And same deal with my hidden bargains strategy, how to find really small stocks trading less than their net liquidation value. And this is in addition to taking you through all technical analysis, fundamental analysis, valuation analysis. I've got 25 modules in the course, 12.5 hours in total length. And so for just a few more days only, I'm offering lifetime access to my online course for the one-time fee of $199. Then in a few days, the price is going back to $349. I'm not sure if I'll ever sell it for this cheap again. And so if you're interested in learning more about that and getting access today, then head on over to my website, clickcapital.io/course. You'll come to this page here where you can learn everything about this course, a little bit about me, and the descriptions of all 25 modules, along with some frequently asked questions. And I do offer a 7-day money-back guarantee, allowing you to watch up to half the course absolutely risk-free. So just come to this course page, enter in your email address, click the blue button. You'll come to the checkout page, just click on apply coupon, type in save 150, then you'll only pay $199. That's a one-time fee, no ongoing costs, lifetime access, and you can check out safely with your credit card or PayPal account. And so if you want to learn more about pairs trading, in addition to all my other strategies, then head on over to clickcapital.io or click the link below this video and get access today. Okay, so just getting back into the daily show. Got that surprise uptick in CPI yesterday, spooked markets a little bit, sold off, then kind of held ground, ticked up into the close. That kind of continued on today. A lot of people in the market are wondering, is that just a normal kind of blip in the data bouncing around, or is it the start of something more to come? Are we going to see more upticks in CPI? We're going to see headline go from 3.1% to above 4%. Well, there is legitimate reason for concern, because looking underneath the hood of those inflation numbers, and when you annualize some of them, we're getting some pretty alarming jumps here that the market was kind of not really expecting. Looking at the monthly change in rent annualized, that spiked up to almost 7%. And just looking at core CPI, which strips out food and energy, because energy's been on the decrease the last year and a half. Month over month, annualized, that's approaching 5% again, and looks to be breaking out of this downtrend we've had for the last 2 years. However, it's even worse when you look at core services CPI. Even the 3-month average annualized is over 6%. And so even though we focus on this yellow line here, overall CPI, and year over year, doesn't look too bad at 3.1%, still above the Fed's target. Core CPI, still just under 4%. But looking at core services CPI, it's almost 5.5% year over year. Now with unemployment at record lows, risk assets ripping to all-time highs, nothing really breaking big out there. The only reason Jay's really got to cut rates is he wants to help the Biden administration get re-elected. But that would be too an obvious move right now, and he could actually light another fire under inflation, just like they did in 2020 when they absolutely flooded markets with trillions of dollars of fake artificial money, not to mention record amounts of government stimulus. It's no wonder we got a huge uptick in inflation. Governments always cause inflation. And so we've just seen retail sales a few weeks back come in hotter than expected. Consumers fully employed out there still spending. US government is at record spending levels, widening that deficit with the Treasury having to issue record amounts of bonds to fill the gap. And the government's budget deficit, that's the difference in what they take in tax receipts versus what they spend. It's financed by selling bonds to the market, and they are all up well across the curve in the amount of issuance. And this year is set to explode overall, with Treasury bond issuance going to reach a whopping 1.9 trillion this year. So what does that mean? Well, basically, simple economics, supply and demand. You got a market with a huge amount of supply coming on, and a lot of that demand coming from China and Japan, who are pulling back on purchases, got half the world determined to get off the US dollar reserve at a time the US government is at record borrowing and spending, which is increasing by the week, sending hundreds of billions of dollars to protect the borders of other countries, helping to push the total US debt from 12 trillion in 2010 to almost 3 times higher, now approaching almost 34 trillion that future generations will have to pay off with their labor. And this also comes at a time of an eerily similar geopolitical setup in the Middle East in the 1970s, with a bunch of hotspots and flare-ups before several Arab countries attacked Israel, which just like today, America stood up for them and caused the Arab oil-producing nations to do an oil embargo on the States, helping to shoot up the price of gas and inflation. And we've still got the largest shipper in the world, Maersk, saying Red Sea vessel diversions could extend in the second half of this year. It's no wonder we've got cargo and shipping rates ripping up over the last couple of months. Now we've got the 2-year yield waking up as well, trading above 450. So the point of all this is the ingredients are there for a resurgence in inflation. Inflation's already ticking up, especially looking underneath the hood. Oil ticks up. It's kind of like the last shoe to drop. We got the consumer out there spending. We got the government spending like a drunken sailor. We got Fed liquidity on the rise, not to mention risk assets inflating once again. There's a lot of money sloshing out around there, and so it shouldn't be too much of a surprise if we do get a swing higher in inflation again. There's a look at the long-term chart of the inflation rate year over year, going back to the early 60s. And so the market's really just hoping, even though this has never really happened before in history when we get this big spike, that inflation just kind of comes down here and stays like this, down to 2%, let the good times roll. And that's exactly what they thought in the mid-70s as well, why even the central bank cut rates back then, only to see a second wave higher, inflation getting up to 15%, taking mortgage rates above that as well. And so typically, new secular bull markets don't start with full employment. The unemployment rate record lows 3.7. You look at the start of the last secular bull market in 2009, unemployment was really high. Economy had a lot of room to grow, which it did. Same deal, the start of the prior bull market in 2003. Unemployment was a bit elevated and it came down throughout that bull market. Same deal with the 90s. Started really high, went down that whole decade before it finished around 3.8 where we are now. So whilst anything is possible in markets, it would truly be strange for the new secular bull market. A lot of people are claiming to start with full employment. But just like I talk about on my online course, Module 23, Mind Over Money, I run you through 20 mental biases that we're all vulnerable to, some that we're actually hardwired for. And one of them is recency bias, and we just see that a lot. Along with herding, it's probably the 2 most common biases in markets, ultimately driven by fear and greed. That's why we've got a lot of people saying the rally can continue. We're just getting started. S&P would have to climb another 25% before we reach the dot-com era irrational exuberance. It's almost like they got a target. I've seen that same crazy valuation in the late 90s and thinking that's a good thing. And I'm not saying we can't get there. We very well could. We saw that in the late 90s. A lot of people knew the stock market was super overvalued, 98, 99. A lot of smart guys went short and blew up. It's why it's when it's parabolic momentum. You don't want to try and be a hero and short the heck out of it. And according to Fundstrap's Tom Lee, when we'll know the stock market has peaked is when it declines on good economic news. And he could be right. We could have that late stage speculative bubble mania run up. There is still a lot of cash and money market funds, dry powder out there, especially if the Fed really wants to juice things up and cut rates. That's going to get the animal spirits flowing even more. And can you just imagine the S&P 500 over 6,000, the Fed's cut rates, unemployment record lows. He's just going to create the most epic blow-off tops possibly in financial markets history. But just like our current day political leaders, Jay Powell and his mates, who are extremely wealthy people themselves, worth over $100 million and the like, they'll be long gone before the rest of us have to clean up their mess for the next 10, 20 years, as they've just inflated the heck out of just about every asset out there and basically just spending the future for their benefit and not really that of younger people. We've even seen headlines like this: fund managers stopped worrying about economics, now he's outperforming the stock market. Does that sound like the new logic we should all stick to? Just focus on numbers going up, forget about everything else? I know that's working right now, but for how long? A lot of people are getting pulled into this easy money gravy train, thinking this is how the market just works all the time. And it's even got some famous traders, like Michael Burry of The Big Short, saying he's now long Amazon and Alphabet, just after he was betting against a few tech stocks in the NASDAQ a few months back, and he had to cough up those bets at a loss. He was betting against semis as well, and he's been talking about for a while the big macro risks out there, how it looks like he's thrown in the towel and just gone long. He's just sick of seeing the price going up. Have a looking back in history, we got that spike in the VIX yesterday. That can mean more volatility ahead. Had been really subdued for a couple of months, and it's kind of loosened up. And just looking back in history of the S&P 500 performance, following the VIX snapping a streak of 50 days or more below a closing level of 15, which we just had, even though looking out 6 months ahead, still average market stats of performance. In the short term, a month ahead, S&P was only higher about a third of the time. And that would follow election year seasonality perfectly as well, which we have been doing so far. We've risen up from the start of the year. Here we are in mid-February. It's expected that we'll roll over for a month into mid-March before it's up and to the right for the rest of the year. And looking back at election years after the previous year was up more than 10%, which we got last year, the market on average adds another 10.5%. That's because government really wants to stay in power, and part of that is the stock market not crashing. So they're going to dial up the spending, do everything possible to keep the economy and everyone happy going into November. But regardless of that, we've still got some, like the billionaire bond king, Jeffrey Gundlach, saying stocks are as overvalued as they were at the start of 2022. He said the new highs resulted from rate cut expectations, which have been excessive. He suggested investors turn to credit and cash, making fund available for when stocks cheapen. And he still thinks a recession is on the table as well. And just a little bit of interesting news I thought I'd share with you guys today. We just saw the recent launch of the Apple Vision Pro. A lot of buzz around it. It's been getting pretty good reviews in the tech blogging community. It does look pretty cool. There's a price tag of $3,500. But the VR headset from Meta, Quest, is much cheaper, $500-600. And so Zuck came out and tried to do like a tech blogger review style video himself, the couch in his living room, actually taking a swipe at Apple. He actually tagged Tim Cook in his post, CEO of Apple, making his case for why he thinks it's better. And you can just tell how anxious he is to not let Vision Pro become the dominant VR headset, because then they'll have the control and leverage over the metaverse, just like the iPhone does with all of Zuck's apps, which they've been pushing back on his ability to track users to serve them personalized ads. However, I think the Zuck did a great job at the points he makes and trying to get people to maybe think twice about spending $3,500 on Vision Pro when they can spend $600 on a Quest. And I'll just share this clip with you now quickly.
So I finally tried Apple's, and I have to say that before this, I expected that Quest would be the better value for most people. Good, and it's like 7 times less expensive. But after using it, I don't just think that Quest is the better value. I think that Quest is the better product, period. And the different companies made different design decisions for the headsets. They have different strengths. But overall, Quest is better for the vast majority of things that people use mixed reality. Now, my friend Kenny is actually capturing this video on Quest's high-resolution mixed reality pass-through right now. We're just here in my living room and see his browser windows and whatever else he's got running up here. So yeah, Quest 3 does high-quality pass-through big screen, just like Vision.
And so there you go, tech product review from one of the richest men in the world. And what a tear he's been on lately. Look at the monthly stock price of Meta, one of the biggest recoveries of a large cap stock I've ever seen. But over a year ago, we were trading down in the 80s. Here we are at 473, staying on the same time frame as Apple, which has clearly slowed down these last couple of years has been underperforming the Nasdaq. They're really banking on Vision Pro to kind of take them forward, generate new buzz and hype around their products. But at 3,500, they've got their work cut out for them, trying to convince a lot of people to cough that up for a new VR headset. Just moving on to Fed Fund futures, still pretty much the same as yesterday. Market pricing in the Fed going to stay on hold till half year in June. And it was a few months back, market was targeting about a terminal rate 3.5%. Now they only think it's going to be about 4% by the end of the year. So the market's moving more in line with what the Fed's been saying. They're only forecasting to cut 3 times this year. Market was hoping for 6 cuts. Stock market's almost extremely greedy again, sitting there at 73. And once again, insiders taking advantage of these prices, doing a lot more selling than buying. And just diving back into the charts, we've got the dollar index holding ground here. That's supposed to be a negative thing for stocks, as a lot of the biggest companies sell around the world, so their export sales translates to lower US dollars with a stronger dollar index. There's gold continuing to pull back a little bit. A soft pullback in crude today, just trading below $77 a barrel. Got a nice little bounce. Chinese equities today, same deal with clean energy, popping up a bit there. And international stock markets also reversing course after yesterday's sell-off. It was ARK Innovation, the winning sector today, up over 5%. Getting a bit of life in the IPO sector. Fresh equity trading really strong as well. Only sector to come off today was energy. Still a bit flat there. Got gold miners as well, really underperforming the underlying. Nice pop up in the transports. Industrials as well, breaking out to all-time highs. And financials just kind of holding ground there. Got Tesla bouncing up a bit here, 2.5%. Trying to hold these 180s as support. Same with PLTR, holding high ground there as well. And more volatility in the meme space, getting some big rips across the sector there. That huge move up and lift on their surprise cash flow positive earnings result yesterday, sending the stock up 35%. There's a look at New York Community Bancorp, which has been in trouble lately, still trying to hold ground above $4. Same deal with other regionals, kind of hanging in there, and JP Morgan continuing to consolidate. All right, guys, there we have it, 5,000 on the S&P. Only on Monday we hit all-time record highs, just below 50.50. Market seems to be still on its parabolic melt-up move, and like I said, as long as we're above this yellow line, the 50-day volume-weighted average price, the market could continue melting up, and it's best to not stand in its way, but rather take advantage of some opportunities out there, like some current degraded pairs diverging from their mean, and having some dry powder ready for when we get that inevitable VIX spike. And like I said, it's a really good time to put on some pairs trades. You get that fast snapback, reversion to the mean, whilst removing market risk, keeping your portfolio market neutral. So if you want to learn more about that strategy, head on over to my website, clickcapital.io, and you can watch half of my course risk-free for the first 7 days. Otherwise, it's only $199 one-time fee for lifetime access. And a huge thank you to everybody who's already purchased it. I'm already getting great feedback, and I'm excited to keep updating this course for many more years to come. Thanks very much for tuning in to the Click Capital Daily Market Show, and I'll see you all again tomorrow night. Cheers.